Hey everyone, in this video I've got one growth stock that's down 63% off the high that I think is an excellent buy for 2024 and beyond. So as usual, I'm going to bring you the video, I'm going to let you know what the stock is, and I'm going to highlight the reasons why I like the investment. So let's jump right into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the stock that I'm talking about is Chinese tech giant Tencent Holdings. That's down 63% off the high. Of course, the company is home to WeChat with over 1.2 billion active users, and that's one of the main reasons why I'm attracted to this growth stock. Of course, that and its other services has revenue up for the last decade, 84.95 billion in revenue. That was up from less than 15 billion in revenue in 2015. Of course, there's always fears that the Chinese government will regulate and clamp down on large businesses like Tencent. The latest fear was the gaming regulations that were going to limit the amount that people could spend on games and online purchases, and that's always going to be the case. I don't think those fears are ever going to go away. However, the rest of its business could continue to thrive even if its gaming segment faces headwinds. The company's profit margin has been excellent in the last decade, although there was a downward trend that has reversed in the last year. Its operating profit margin of 25.84% is a solid profit margin, and it's on its way up after hitting these lows of around 19%. Earlier in the decade, Tencent was operating at operating profit margins as high as 36%. Now that the Chinese economy is reopening and recovering from those lockdowns, it could face better profitability going forward, although the economy is recovering more slowly than many analysts have expected, including myself. I thought the Chinese economy would recover much faster than it has been. Its debt problems, the real estate sector, all of which are contributing to slower growth in that economy. Although one of the main reasons for that is worldwide people are spending more money on services, and so the Chinese export economy, which contributes a major portion of that economy's strength, has not been as strong. In 2024, that trend is likely to continue as people unleash that pent up demand for away from home activities. However, I think starting in 2025, consumer behavior will normalize. All that pent up demand will be out of people's system, and I suspect consumer behavior will return to a more normalized breakdown between goods and services, which I think will be good news for the overall Chinese economy, and companies that operate within that economy will capture that rising benefit from that tailwind of economic growth. Certainly, that's what it feels like Wall Street expects from Tencent. What I have here is Tencent's revenue and profit expectations for the next 2 years. Analysts expect Tencent to grow revenue by 10.7% in 2024 and 10.9% in 2025. Analysts expect earnings per share growth of 17.8% in 2024 and 15.1% in 2025. Interestingly, Tencent's earnings per share growth rate is decelerating. You could see in 2023 it was 35%, then 17%, then 15%. However, its revenue growth is accelerating from 10.6 to 10.7 to 10.9. I would rather have this be flipped, where earnings per share is growing at an accelerated rate. Also, earnings per share growth rate is decelerating much faster than revenue growth is accelerating. So this isn't very much of a desirable trait, although it is solid that both top and bottom line are growing at double digits. It just would have been excellent if they were both growing at an accelerated rate. But you don't need that with every single company, especially when valuation doesn't require it. We're going to see in a little bit, the valuation is attractive, especially when we incorporate these earnings per share expectations for Tencent. And one of the more attracting facets of Tencent is its ability to generate cash flow. $28.84 billion in cash flow from operations in the trailing 12 months. That's a record high for the company, and that's significantly higher than the $6 billion it generated in 2015. You can see a very nice upward trend here from Tencent in increasing its cash flow from operations as revenue has grown. Also, if we look at cash flow from operations in relation to revenue, you can see it's generating a nice percentage of cash flow to sales. Let's go back to sales here. On 85 billion in sales, it generated 28 billion in cash flow. That means it's turning each dollar of sales into cash flow robustly at a rate that's nearly or above roughly 30%. That's a very good ratio for companies, especially companies that are growing revenue at double digits. That's attractive, and that's one of the reasons why I like the stock. The price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. With that being said, and now that you have a better understanding of the price to earnings ratio, you can see how important that is to valuation. Tencent is selling at arguably the cheapest it's ever been. On a forward price, not forward, but just on a price to earnings ratio, which looks at trailing 12-month earnings, it's selling at 13.06. According to this metric, the stock has never been cheaper. Okay, 1 point right here, it's been cheaper than where it's at right now, but for the most part in the last decade, this stock has been considerably more expensive. And so you're getting this stock at a bargain price right now. And of course, there's reasons for that, given all the geopolitical risks in China and the Chinese government cracking down on business and really clamping down and not allowing businesses to operate freely. You can understand the risks and the hesitations, but I feel that's more than incorporated in its valuation. And I think investors are getting a good risk versus reward with Tencent stock. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.